Welcome back to Friday Five questions, quick answers this week featuring my friend Sam Gamble. And Sam, last year, almost this exact same time, I remember it was on St. Patrick's Day. I'm wearing the green, same jumper that I had, same sweater I had last year, in my lucky charm here. You were here in London. We just gotten back from MIPIM. You did a presentation at Workplace Creations Group. Today is going to be slightly different, not as long, but we'll put a link to that presentation down in the show notes. Sam, welcome to Friday Five.
Well, thanks for having me. Yeah, it's this year was much more. It was sad. I was sitting in Canada, -20, watching everybody in southern France on LinkedIn.
Well, no cycling through the mountains and bike crashes this year for you, but some things have changed in the last year. You have a lot more facial hair than I'm used to. I almost didn't recognize you.
Yeah, it turns out I can grow a beard. My dad told me I couldn't for like my whole adult life.
Well, it must be really cold in Canada, so comes in handy. Right, well, let's kick these quick questions off. Sam, landlords these days are doing a lot to attract tenants, including building out spec suites. Is that good for business?
I mean, tenants, I think, are expecting more. And so landlords kind of need to respond, right? But it is like a way different model, bigger CapEx spend coupled with shorter leases. So it's kind of a tricky thing to do. And I think, you have to be really careful if you're doing CapEx expenditures every 3 to 5 years. Is it even really CapEx anymore? Or is it kind of OpEx dressed up as CapEx? So I think we really need to, like on the landlord side, really need to kind of figure out a way to make apples to apples comparisons between traditional leases and spec suites. So you can kind of make the right decision and make sure you're not kind of converting a vacancy problem now to a cash flow problem later. Like I know I've been doing a bunch of work with Workplace Creations, and I think they're ahead of the curve. It's funny you mention them, but yeah, they're helping kind of design and build spaces that kind of hold their value across multiple turnovers, and so it's kind of truly CapEx, and so that's kind of the business model. I think if you're getting into spec suites, you need to really be kind of thinking in those terms.
Well, the managed office solution, aka spec suites, has grown massively in London the last year, 900 and something % increase in demand. But today, office customers have so many different options, from traditional office footprints to managed to co-working and serviced offices. Is this just making the decision harder for customers, or is this a good thing?
Yeah, no, I mean, really, it's kind of the flip side of the spec suite question. I mean, in general, it's a good thing to have more options, but it does make the decision harder. And the problem is that these options are all structured so differently. So again, like how do you kind of compare, like from a financial basis, the different options? And really kind of you can make any option look the cheapest, kind of depending on what measure you pick. And I think CFOs know that as well. So there's kind of a little bit of a game. And unfortunately, the problem is it turns into this financial debate, like which one is cheaper. And what people are missing out on is the strategic conversation, which is way more important. And if that strategic decision of kind of which option is best for the workforce doesn't happen, then people are really missing out. So again, you want to have like an apples to apples comparison on the financial side. So you can just say, hey, this option, we get this, and for this many more dollars or this many more pounds per month, we get these additional benefits. Is it worth it?
And, sometimes the cheapest isn't always the best option, as we know. Reminds me of the episode of Brave Ideas with Amy Taylor we did last year. She talks about these apples to apples comparisons. But, Sam, you do a lot of work around the valuation side for owners and landlords, and helping understand how to underwrite the different business models. Is there a particular business model that is the right one for delivering flex?
Ultimately, I kind of come back to that kind of famous Charlie Munger line, tell me the incentive and I'll tell you the outcome. So I think really the business model doesn't matter so much as long as everybody really understands the agreement and they make sure that the incentives are aligned for what they want to happen.
Well, alignment is absolutely important. Understanding that alignment, understanding how the waterfalls work, understanding what sort of margins look like, that all comes back down to the modeling. So why do you think it's so hard for landlords and operators to get on the same page with underwriting this model?
Flex is essentially kind of a cascading system. So if you place all the real estate types on a grid, right, and you have high turnover costs or low turnover costs, and you have high churn versus low churn on the other axis, and you plot out all the different real estate, they all land on this diagonal, right? So you have, like, say, industrial leases. They hardly ever turn over. There's hardly any churn. But when they do, it's really expensive. And on the other end, you have hotels, which they turn over every night, but that's not too expensive. So both, anything kind of along this diagonal is really easy to model. But Flex falls off that line. And I think you have higher churn because you have shorter term leases. And like we were talking about before, if you do the CapEx wrong or you have the wrong product mix, you might have really high costs to turnover. And so you're sitting there with higher churn, potentially higher costs, and the decisions that you make impact future decisions. If you build out too much co-work or not enough co-work, you get that product mix wrong. It has all these knock-on effects. And that's why I think it's super hard to model and super hard to operate.
Yeah, it's a good point you bring up. And the good thing is when you do crack the model and you do operate it well, it can really drive NOI for the building, can drive great destination experience for the guests coming into the building. And ultimately it becomes a de-risked model for the building looking forward into the future, as we know, because all these other Friday Fives we've been talking about, creating a hospitality experience. And that is what's needed for future proofing. Sam, this has been fantastic. I have one last question for you. If there's one thing about the flex office industry that you could fix, what would it be?
We spend a lot of energy trying to justify flex as an asset, and specifically around like the future exit value. It's just the way the models work. And it just feels like we're, I don't know, like arguing about like what a Pokemon card or something's going to be worth in 10 years. Like, will it be worth more? I don't know. Maybe it will. But because we're looking at these short-term holds, that exit value is really, really important. And ultimately, I think really what's more important is like, is the asset earning money, and is it earning more money the next year and the year after that and the year after that? So, if I could wave a magic wand, I'd love it if kind of the owners that were getting involved in Flex were longer term asset owners and started caring less about the exit value and cared more about the cash flows it's returning. Because, if you do Flex well, it cash flows great. If we had more owners doing that, the valuation system could catch up. And then the right exit values can start getting put in, and then shorter term owners could kind of move in. Like I said, if I could wave a magic wand, it would be to have a whole bunch of long-term owners show up and really invest in Flex.
So essentially, Sam, what you're saying is there's no overnight fix, but there might be a 5-year fix, which plays into my theory. I think we're going to see these institutional investors and these early developers that are looking to flip it in 3 to 5 years exit office. I think we're already seeing this exit from office. There's money coming back in, of course. I think the office of the future will be financed by more patient capital. And once we have that patient capital in here and showing that it's a great investment on a EOL cost basis, it's generating nice annual returns, and it's predictable, I think then we'll see the mature markets come back in, and then we'll have a whole new real estate game.
Yeah, that would be great. That's what I'm hoping. And I think we're starting to see it.
Sam, one other thing has changed since the last time you were here. I've changed my black coffee mug from bold to brave. It only took me 3 years to do it, but there we go. Sam, thanks for taking the time to share your insights with us. Any final words for the audience?
No, well, I missed everybody at MIPIM, but I'm going to be over in the UK in June. So hopefully I'll catch a bunch of you when I'm over, and looking forward to seeing you, Caleb.
Awesome. Well, always look forward to seeing you, Sam, in person, in the flesh. And until we get on our next Zoom call, take care of yourself, and thank you for tuning in. Until next time, take care of yourself.